Hello and welcome to Earnings Echo. We put together the most important information about Maplebear Inc., DBA Instacart. If you're listening to this, you're likely wondering if, well, the market's current read on this company is just fundamentally broken.
Yeah, and we're going to strip away all that noise today and look strictly at the Q1 2026 data.
Right, so starting with the top line, the company just crossed a pretty major threshold. We're looking at a billion-dollar quarter, right? Let's get the exact Q1 scorecard and what they're projecting for Q2.
Well, you're spot on. Q1 revenue actually hit $1.019 billion, which is up 14% year over year.
Wow, over $1 billion.
Yeah, it's a huge milestone. And gross transaction value, or GTV, reached $10.29 billion, so that's up 13%. But the bottom line is accelerating even faster. GAAP net income came in at $134 million.
Which is, what, a 36% jump?
Exactly, 36%. And Q2 guidance points to continued double-digit growth. They expect GTV to climb 11 to 13%, and adjusted EBITDA is projected between $290 million and $300 million.
Okay, so those top-line numbers are definitely surging. But, digging into the volume metrics, there's a really interesting disconnect. GTV grew 13%, but actual order volume only grew 10% to 91.2 million.
Right.
So why is the transaction value outpacing the sheer number of orders so noticeably?
Well, it really comes down to user behavior changes that are tied to a policy shift. They're lapping the Q1 2025 rollout of that $10 minimum basket requirement for Instacart Plus members.
Oh, right, the minimum basket feature.
Yeah, so by enforcing that minimum last year, they essentially forced users to add, that one extra item to their cart.
Right, and now we're just seeing the downstream effect of that habit.
Yeah.
People are just accustomed to building bigger baskets now.
Exactly. That habit drove average order value up to $113 without actually requiring more frequent orders. Plus, you have operational upside coming from high-margin areas.
Like the ads business.
Yeah. Advertising and other revenue hit $286 million, up 16%. And they're securing major enterprise wins, too, like Aldi launching a redesigned platform on Storefront Pro.
Okay, so the revenue engine is firing. But I did notice a slight margin squeeze on the way down. Jamp gross profit as a percentage of GTV dipped from 7.4% to 7.2%. Where exactly is that cash leaking out?
Right, so that decrease is heavily tied to scaling their Carrot Ads network. They're basically paying out more to publishers as that network expands.
Got it. Publisher payouts.
Yeah, but it's not all margin degradation. They saw operating expense leverage elsewhere. Specifically, they benefited from the repeal of Canada's digital services tax.
Let's contextualize these numbers with management's tone on the earnings call. Are they, bracing for turbulence given the broader macro environment, or are they leaning in?
I would say CEO Chris Rogers was highly confident. He emphasized aggressive AI investments, notably the Claude integrated cart assistant that's now rolling out to U.S. customers.
Okay, that's interesting.
He also highlighted their enterprise-led international expansion, which is really fueled by the InstaLeap acquisition.
But surely they acknowledge some macroeconomic drag, right? Consumers are definitely feeling the pinch at the grocery store.
Absolutely. They didn't ignore it. They acknowledged a heavily value-focused consumer. To adapt to that, we're seeing outperformance in club retailers on the platform.
So people are buying in bulk to save.
Yes, and management is aggressively pushing for price parity with in-store pricing just to keep those cost-conscious buyers engaged.
Which brings us to the ultimate question for you as an investor, which is valuation. We ran a reverse DCF model. And, for anyone unfamiliar, a reverse discounted cash flow is not an exact science.
No, definitely not.
But it acts like a decoder ring. It tells us exactly what growth expectations Wall Street has baked into the current stock price.
Yeah.
So does the current $42.50 share price make sense given that 36% net income growth we just discussed?
Well, the math suggests a massive disconnect, actually.
Right. How massive?
When we plug their baseline FY25 net income of $447 million into the model, and we use a standard 9.5% cost of equity and a 3% terminal growth rate.
Okay.
The current market cap of roughly $10.2 billion implies Wall Street expects just a 7.9% net income CAGR over the next decade.
Wait, I have to stop you there. A 7.9% implied annual growth rate. That makes zero sense. Q1's net income already paces at an annualized rate of roughly $576 million.
Right.
The market isn't just being cautious here. They are pricing in a doomsday scenario.
Yeah, the valuation is extremely conservative. You're completely right. The market is heavily pricing in long-term competitive threats and, potential market share losses rather than rewarding their current highly profitable execution.
So putting this all together, They are generating massive cash flow, enough that management just authorized a new $1 billion buyback.
Right, they're on track to return the majority of free cash flow to shareholders.
They're literally putting their money where their mouth is regarding the stock's undervaluation.
Precisely, it's a very strong long-term investment story.
So here is the final echo you need to take away today. The market is looking at Instacart purely as a highly vulnerable delivery app. But under the hood, they are building a highly profitable toll booth, an enterprise software and advertising ecosystem that retailers are relying on. And finally, the obligatory disclaimer. All content in Earnings Echo is AI-generated information and does not constitute investment advice. Investing involves risks. We assume no liability for your investment decisions. Do your own research before taking action. Numbers checked, portfolio prepped. Catch you again soon.